Night settles over America's financial capitals. Trading floors dim, but screens continue to glow, quietly transmitting numbers that carry weight far beyond the walls of Wall Street. For decades, the United States has stood as the anchor of the global financial system, issuing the world's reserve currency, setting the tone for interest rates, and absorbing capital in times of fear. Yet tonight, beneath the surface calm, tension builds. Treasury yields press upward, testing levels unseen in years. The dollar strains against other major currencies, while liquidity once abundant and cheap moves more cautiously, almost defensively. Public debt has crossed historic thresholds. Corporate refinancing costs are rising, and households feel the pressure through mortgages, credit cards, and rents. This is not a sudden collapse, but a narrowing corridor where debt, interest rates, and global power converge. History shows that crises rarely announce themselves with panic at first. They begin with subtle shifts in confidence, with markets questioning assumptions long taken for granted. As capital flows adjust and global rivals recalibrate, the United States approaches a moment where its financial dominance is tested not by a single shock, but by the cumulative weight of choices made over decades. The early signs of crisis rarely arrive as headlines screaming collapse. They emerge quietly, embedded in data that most people rarely watch. Yield curves flatten, then invert, signaling that markets expect slower growth ahead. Credit default swap spreads widen, suggesting that investors are demanding higher premiums to insure against failure. In real estate, transaction volumes fall even as prices hesitate to adjust, revealing a market held up by low supply rather than strong demand. Banks tighten lending standards, not because regulation suddenly changes, but because confidence does. Meanwhile, global capital that once flowed effortlessly into U.S. assets becomes more selective. Foreign central banks rebalance reserves, and large funds shorten duration, reducing exposure to long-term treasuries. Liquidity does not vanish overnight, it retreats. The cost of money rises unevenly, hitting small businesses and leveraged households first. These signals, taken alone, appear manageable. Together they form a pattern seen before in other economies at the edge of stress. The danger lies not in any single indicator, but in their synchronization when interest rates, asset prices, and expectations begin to reinforce one another in a tightening loop that narrows the margin for error. To understand how pressure turns into shock, it is necessary to examine the mechanics beneath the surface. Modern financial systems run on leverage and rollover. Governments refinance maturing debt. Corporations depend on continuous access to credit markets, and banks rely on short-term funding to support long-term assets. When policy rates rise, this structure becomes fragile. Higher yields reprice everything at once. Bonds fall, equity valuations compress, and real estate loses affordability. As collateral values decline, lenders demand more margin, draining liquidity further. This feedback loop is amplified by global linkages. U.S. interest rates transmit instantly through currency markets, forcing emerging economies to defend exchange rates or accept inflation. Dollar-denominated debt becomes heavier abroad, increasing default risk and feeding back into global risk sentiment. What begins as a domestic tightening cycle evolves into an international stress test. The system does not break because money disappears, but because trust in continuous refinancing weakens. Once that trust erodes, even solvent institutions can face strain, as timing, not fundamentals, becomes the decisive factor. History offers a clear lens through which these dynamics can be understood. In 1997, the Asian financial crisis exposed how fast capital could reverse when confidence cracked. Countries that had relied on short-term foreign funding watched currencies collapse as reserves drained and interest rates spiked. The IMF stepped in, not to erase losses, but to impose stability at a painful cost to growth and employment. Argentina's repeated debt crises tell a similar story of dependence on external financing, rigid policy choices, and delayed adjustments. Greece, bound by a shared currency, lost monetary flexibility and endured years of contraction as yields soared and fiscal space vanished. Turkey and Venezuela illustrate how inflation, political pressure on central banks, and currency weakness can interact, eroding purchasing power and social cohesion. These cases differ in scale and structure, but they share a common lesson. Crises accelerate when markets believe policymakers are constrained. The United States is not these countries, yet it is not immune to the logic of global finance. Size offers time, not exemption, and confidence remains the ultimate variable. What separates the United States from past crisis cases is scale, credibility, and the central role of the dollar. Yet these advantages also carry hidden vulnerabilities. As the issuer of the world's primary reserve currency, the U.S. absorbs global savings, allowing persistent deficits to be financed with relative ease. But this privilege depends on belief that treasuries remain the safest asset, that inflation will be contained, and that institutions will act independently under pressure. When yields rise sharply, servicing costs on federal debt increase, crowding out fiscal flexibility. At the same time, a stronger dollar tightens financial conditions globally, reducing foreign demand for U.S. exports and feeding back into corporate earnings. Housing, long a stabilizer of American household wealth, becomes less accessible as mortgage rates climb, freezing mobility and consumption. Equity markets, sensitive to discount rates, reprice future growth downward. None of these effects are catastrophic in isolation. Together they test the resilience of a system built on confidence, leverage, and continuous capital inflows, conditions that have defined American financial power for generations. The impact of these forces is not confined to charts or balance sheets. It reaches deeply into everyday life. For households, higher interest rates translate into delayed home purchases, rising rent burdens, and heavier monthly payments on existing debt. Credit, once used to smooth consumption, becomes a source of stress. Small businesses face higher financing costs just as demand softens, forcing difficult choices on hiring and investment. Job markets, often the last to turn, begin to show strain through slower wage growth and reduced hours. Retirement portfolios fluctuate as bond and equity values adjust simultaneously, challenging long-held assumptions about diversification. Local governments feel pressure as borrowing costs rise, affecting infrastructure projects and public services. These micro-level effects mirror patterns seen in past crises abroad, where the real economy absorbed the shock after financial conditions tightened. The difference lies in perception. In the United States, gradual erosion can feel less dramatic, yet its cumulative effect can be just as powerful, reshaping behavior long before any official declaration of crisis is made. As stress builds, attention turns to the institutions designed to manage it. The Federal Reserve stands at the center, balancing its dual mandate under conditions that rarely align. Inflation control demands tight policy, yet financial stability calls for flexibility. When rates rise too far, cracks appear in credit markets, money market funds, and leveraged sectors dependent on cheap funding. When policy eases too quickly, inflation expectations risk becoming unanchored. Fiscal authorities face a parallel dilemma. Expanding deficits can cushion downturns, but markets scrutinize sustainability when debt levels are already elevated. Political polarization further complicates response, slowing decision-making at moments when speed matters most. Globally, central banks watch one another, aware that unilateral moves can trigger capital flows and currency swings. Coordination, once a hallmark of crisis response, is harder in a multipolar world. The tools remain powerful: liquidity facilities, swap lines, emergency lending, but their effectiveness rests on credibility. Markets must believe that interventions are temporary, targeted, and backed by institutional resolve. Without that belief, even large-scale actions can lose their calming effect. Beyond official responses, markets themselves attempt to adapt. Investors shorten horizons, favoring cash and near-cash instruments over long-duration assets. Volatility becomes a feature rather than an exception, reflecting uncertainty over policy direction and growth. Corporate behavior shifts as well. Share buybacks slow, capital expenditures are deferred, and balance sheets are fortified against refinancing risk. In the banking system, liquidity coverage ratios rise not because regulators demand it, but because recent shocks have reshaped risk perception. Non-bank financial institutions, less regulated and more interconnected, draw closer scrutiny as potential transmission channels. Internationally, trade patterns adjust as currency movements alter competitiveness. These adaptations are rational, yet collectively they reinforce caution. When too many actors seek safety at once, growth decelerates further. This is the paradox of light-cycle economies. The very steps taken to reduce risk can amplify systemic fragility, especially when confidence is thin and policy space is limited. Comparisons with global crises reveal both warnings and boundaries. Unlike emerging markets during the IMF interventions of the late 1990s, the United States borrows in its own currency and maintains deep domestic capital markets. It does not face the same immediate risk of forced devaluation or external default. Yet, Greece's experience underscores how quickly market access can change when debt trajectories appear unsustainable. Argentina demonstrates the cost of postponing adjustment, while Turkey shows how political pressure on monetary policy can erode credibility. Venezuela stands as an extreme case, where fiscal dominance and currency collapse destroyed savings and social stability. These examples are not predictions, but reference points. They illustrate mechanisms rather than destinies. The common thread is the speed at which confidence can shift once investors question institutional constraints. For the United States, the challenge is not survival, but preservation of trust that policy choices will remain anchored to long-term stability rather than short-term relief. As pressures converge, the question becomes how far adjustment must go. Economic rebalancing often occurs through slower growth rather than abrupt collapse, but the path is uneven. Asset prices may stagnate for years, eroding real wealth without dramatic headlines. Inflation, even if moderated, can remain above past norms, quietly transferring resources from savers to debtors. Fiscal priorities shift as interest payments consume a larger share of the budget, limiting investment in productivity and social programs. In this environment, inequality tends to widen. Those with access to capital and flexible income adapt more easily, while wage-dependent households bear a heavier burden. Regional disparities intensify as capital concentrates in perceived safe zones. These outcomes mirror patterns observed in post-crisis economies elsewhere, where recovery was prolonged and uneven. The absence of a singular breaking moment does not imply safety. It signals a drawn-out test of resilience, patience, and institutional strength. Government response in such conditions is rarely decisive in a single stroke. Instead, it unfolds through a series of calibrated moves. Fiscal policy may emphasize targeted relief over broad stimulus, seeking to support vulnerable sectors without reigniting inflation. Infrastructure spending is framed not only as growth support, but as a signal of long-term commitment. The Treasury adjusts issuance strategies, balancing maturity profiles to manage refinancing risk as yields fluctuate. At the Federal Reserve, communication becomes as important as action. Forward guidance aims to shape expectations, reducing volatility by clarifying intent. Liquidity facilities are prepared, not always deployed, to reassure markets that backstops exist. Internationally, swap lines with other central banks serve as pressure valves, easing dollar shortages abroad. These measures do not eliminate risk, they buy time. The effectiveness of that time depends on whether underlying imbalances, debt accumulation, productivity gaps, and demographic pressures are addressed rather than deferred. For individuals, navigating this landscape requires a different mindset from the era of easy money. Financial decisions become less about maximizing returns and more about preserving flexibility. High leverage, once rewarded, turns into a source of vulnerability when rates remain elevated. Households reassess fixed versus variable borrowing, recognizing that stability has value beyond short-term savings. Emergency reserves regain importance as employment becomes less predictable. In investment behavior, diversification is reconsidered not as a slogan but as exposure to truly distinct risks, including cash and inflation-protected assets. Skills and mobility emerge as forms of capital, allowing workers to adapt as industries adjust. These strategies echo lessons learned in countries that endured prolonged adjustment. Survival does not depend on predicting crisis timing, but on reducing fragility. In uncertain systems, resilience at the individual level becomes a quiet but powerful buffer against broader economic stress. At the systemic level, resilience is measured by liquidity and trust. Liquidity is not merely the presence of cash, but the willingness of institutions to transact under stress. During calm periods, bid-ask spreads narrow and funding rolls effortlessly. Under pressure, those spreads widen, repo markets tighten, and even high-quality collateral faces scrutiny. Credit default swaps become a barometer of perceived risk, rising not because default is imminent, but because uncertainty demands insurance. These movements influence behavior across the economy, from banks adjusting balance sheets to corporations delaying investment. Globally, shifts in U.S. financial conditions reshape power dynamics. Nations diversify reserves, explore alternative payment systems, and negotiate trade in non-dollar currencies, not to abandon the dollar, but to reduce dependence. This gradual recalibration does not dethrone American influence overnight. It signals a world where financial dominance must be continuously reinforced through stability, transparency, and disciplined policy rather than assumed as permanent. The long-term implications extend beyond economics into geopolitics. Financial strength underpins diplomatic leverage, defense spending, and alliance structures. When fiscal space narrows, strategic choices become more constrained. Allies watch us policy consistency as closely as markets do, assessing whether commitments remain credible. Adversaries, in turn, test boundaries through economic statecraft, using energy, trade, and technology restrictions as tools. The cost of financing these contests rises as interest rates remain elevated, forcing prioritization. Historically, periods of financial strain have coincided with shifts in global order, not through abrupt collapse, but through gradual redistribution of influence. The United States retains unmatched capacity, yet that capacity is shaped by economic discipline. Maintaining leadership in a more contested environment requires aligning domestic stability with external ambition, a balance that becomes harder when financial margins thin. As the cycle matures, the defining risk is complacency rather than catastrophe. Extended periods without crisis can dull sensitivity to warning signs, encouraging the belief that existing tools will always suffice. Yet history shows that systems fail at their margins, where incentives misalign and buffers erode quietly. In the United States, these margins appear in underfunded pensions, highly leveraged corporate sectors, and local governments dependent on volatile revenues. They also appear in social tolerance, as economic strain tests public trust in institutions. Restoring balance is not a matter of returning to the past, but of adapting to new constraints. Sustainable growth depends less on financial engineering and more on productivity, labor participation, and innovation. The choices made during this period, how debt is managed, how policy credibility is preserved, and how risk is shared, will determine whether the coming years are remembered as a managed adjustment or the prelude to deeper disruption. In this environment, narratives matter almost as much as numbers. Markets react not only to data releases, but to the story policymakers tell about the future. When inflation readings ease but language remains hawkish, uncertainty persists. When growth slows yet optimism dominates official statements, credibility is questioned. This tension shapes expectations embedded in bond yields, equity risk premiums, and currency valuations. A misalignment between narrative and reality can amplify volatility as investors reposition abruptly. The United States has historically benefited from a reputation for pragmatic adjustment, where course corrections, though imperfect, were eventually made. Preserving that reputation requires acknowledging limits to debt expansion, to monetary intervention, and to the assumption that global demand for U.S. assets is infinite. Transparency, even when uncomfortable, becomes a stabilizing force. In periods of transition, honesty about trade-offs can anchor confidence more effectively than reassurances that deny structural change. The path forward is unlikely to follow a single of crisis or recovery. More plausible as a sequence of stresses, pauses, and partial recoveries that test endurance. Financial markets may stabilize temporarily, only to face renewed pressure from external shocks, geopolitical conflict, energy price swings, or sudden shifts in capital flows. Each episode leaves a residue, tightening conditions incrementally. Over time, these layers accumulate, shaping behavior and expectations. Businesses plan conservatively, households save defensively, and policymakers operate with reduced margin for error. This slow compression is harder to dramatize than a crash, yet its impact can be profound. It alters risk-taking, dampens innovation, and redefines what stability means. For the United States, navigating this phase requires accepting that dominance does not eliminate vulnerability. It transforms it, demanding constant adaptation in a system that no longer offers easy solutions. Amid these constraints, the question of adjustment becomes unavoidable. Historically, economies reduce excessive debt through a combination of growth, inflation, restructuring, and time. None of these paths are painless. Faster growth requires productivity gains that cannot be legislated overnight. Inflation eases real debt burdens but erodes purchasing power and trust if unmanaged. Restructuring, common in emerging markets, is politically unthinkable for the United States. Yet implicit adjustments occur through financial repression and regulatory change. Time, often the chosen path, demands patience and social cohesion. As interest rates remain higher than the previous decade's norms, the cost of waiting increases. Each budget cycle reallocates resources toward debt service. Each refinancing tests market appetite. This gradual discipline can restore balance, but only if accompanied by credible signals that excesses will not simply be rolled forward. In this sense, adjustment is less a technical process than a social contract, an agreement on who bears costs, who receives protection, and how stability is defined in a more constrained world. For viewers seeking practical insight, the lesson is not to anticipate a single breaking point, but to recognize regime change. The era defined by near-zero rates and ever-rising asset prices has ended, replaced by one where capital carries a visible cost. In such regimes, errors compound faster. Overexposure to illiquid assets becomes risky, while dependence on constant refinancing leaves little room for shocks. Income stability gains importance relative to speculative upside. Geographic and sector concentration, once efficient, now magnifies downside. These principles echo across past crises, from Greece's lost decade to Argentina's recurring resets, where those who reduced fragility early preserved optionality later. The American context differs, yet the logic holds. When systems tighten, survival favors those who plan for variability rather than certainty. Understanding this shift allows individuals and institutions alike to respond with intention, not fear. As the broader economy navigates a period of constrained but consequential change. As this chapter unfolds, the United States stands not on the edge of inevitability, but at a threshold of choice. Debt, interest rates, and global power are not forces acting in isolation. They interact through policy decisions, market behavior, and collective belief. History suggests that outcomes are shaped less by the presence of pressure than by the response to it. Managed adjustments preserve influence, while denial accelerates loss of control. For individuals, awareness becomes a form of preparedness. For institutions, credibility becomes capital. And for the nation, stability is no longer defined by the absence of stress, but by the capacity to absorb it without fracturing trust. The coming years may lack the drama of sudden collapse, yet they will leave a lasting imprint on how Americans understand risk, security, and leadership in a changing world. What remains constant is the lesson repeated across crises. Power in finance endures only as long as confidence is earned, renewed, and defended quietly, persistently, and before the moment of necessity arrives. In the closing frame of this story, the camera lingers not on trading floors or policy meetings, but on ordinary routines shaped by invisible forces. A family recalculates a budget as prices adjust slowly upward. An entrepreneur postpones expansion, waiting for clarity that may not come. A young worker weighs opportunity against stability, sensing that the assumptions of the previous decade no longer apply. These choices, multiplied across millions of lives, define the real outcome of macroeconomic stress. The United States has faced thresholds before and emerged altered, not diminished, when adaptation replaced denial. Whether this period becomes a quiet recalibration or a prolonged erosion depends on discipline exercised early. When options still exist, economic power is rarely lost in a single event. It fades when warning signals are ignored. In that sense, the crisis is not only a risk ahead, but a mirror held to the present, reflecting how seriously a society treats limits, responsibility, and the long arc of confidence that sustains its place in the world.